Next, I want to talk just briefly about the phase shift, the accumulation to the distribution phase of life. Now, you have spent your whole career in this accumulation period in which you've been saving, paying off debts, putting children through school, all those things, but steadily through your career, most of you have been putting little bits of money into saving, a little bit over time, little bit. And that accumulation phase has now let you amass a nice TSP, some other savings that you are now going to no longer add to. The day you retire and have no more earned income, you quit saving in retirement accounts. That day ends. So get in your mind that the accumulation phase is a phase. It has a beginning and an ending point. For most federal employees, that is the way that works. And then you find yourself shifting to the distribution phase. Now, some people, it takes several years. They end the accumulation phase. They don't have to withdraw from their assets, and they just build a little bit, and then they have to start the distribution phase and taking money out of the account. That's fine, but you need to understand that you are leaving accumulation, moving to distribution, and that's okay. This is one of the hardest concepts or the hardest emotional items for federal employees to be okay with. You mean I'm not going to save anymore? I'm going to spend it? What if I run out? All those are valid emotional experiences that you have as you transition from one phase to the other. That's very normal. But prepare for that. Mentally think through that and be willing to gravitate to that distribution phase in which you get to take money from your account. And as long as you do that with a plan in mind, how you're going to draw, how much, how long it's going to last, how it's invested, you tie all those pieces together, then you have the potential for success as you live through the distribution phase. So plan it, think about it, let this graphic here of going from the accumulation phase to the distribution phase, let it sink into your mind, because it will take 2 or 3 times of you thinking through this to get comfortable with it as you plan for retirement. We want to talk about the major financial changes that happen in retirement. I'm just going to lay out some pre-retirement ideas, some post-retirement ideas, and just briefly talk about them as we go along. Number one, in pre-retirement, we typically have housing costs, and then in retirement, hopefully those mortgages get paid off. So that's a major shift. You have a $1,500 mortgage, you see that either at retirement or maybe within 5 years of retirement, that mortgage will be paid off completely. Then you need to make sure that your retirement budget builds. I've got to draw heavier those first few years to pay that mortgage payment. And then when that expense is gone, I won't need to draw as much from my assets. A lot of times that's the way that actually plays out in real world. Next, you have in pre-retirement, you have your work-related expenses. You also have family expenses. If you were raising a family while working, you've got those great years of everything from paying for diapers to buying a car for the 16-year-old to that wonderful college bill that you covered for so many years. Hopefully, as you retire, those highest expense years for the family are behind you. And then again, as you look at your budget, get serious about that last one graduating from college, often you see that those expenses will again reduce. I had one federal employee talking to me with 3 teenage boys in the house. He said they went through about 7 gallons of milk a week. So it can be very expensive. I myself am relating that. My oldest is 14 now. I've got 4 children, and they do obviously get more expensive as we go, and everybody tells me you hadn't seen anything yet. Just hang in there. So, but when that gets behind you, then again, you rebuild that budget away from those kind of expenses. Last, in your pre-retirement expense category, your TSP contributions. Now, this is the hard one again. You will no longer be saving money in that TSP. Good news is, while you're working, whatever you're putting in the TSP, those are dollars you're not living on. You're saving them. So that's not going to have to be replaced in retirement. A retirement budget doesn't have to have a column called savings on it. Again, why? Because you've left that accumulation phase for that distribution phase. Now, the things to consider in retirement or post-retirement is having that mortgage possibly paid off, potentially higher health care costs, long-term care costs, entertainment-related expenses. Are you going to travel? Where are you going? How are you going to spend your time? Just because you're not working doesn't mean you're going to spend less necessarily. Remember that. Sometimes you can spend more with free time on your hands, so make sure you've built that in the budget. We've had folks come and say, well, I'm going to quit doing this and this and this so I can retire. And then they retire and they don't quit doing those things. They actually do more of them because they have more time to do those luxury things they enjoy. And that can be financially devastating to you. So make sure you're realistic with yourself. Look yourself in the mirror and say, I'm going to be okay doing without this. Or, that's not real. I really need this luxury or this particular thing to have a good quality of life. And again, then you better keep working if you can't afford it in retirement. And lastly, your asset withdrawals. In retirement, you go from accumulation. Now you're distributing the money. You just want to do it wisely. So lastly, let's talk about retirement and estate planning, just brief. I want to throw out a few ideas. One, you want to make sure you're coordinating your retirement distributions with your estate plan. Now, I can't give you all the solutions here at one time, but I'll give you a couple. Last year, the law changed to say when you're 70 and a half or older, any of your required minimum distributions and up to $100,000 of your IRA type money, your qualified money, can be gifted straight to charity. Never hits your tax return. No adjusted gross income increase, nothing. You can just gift that money straight out to charity. So if you have amassed a good TSP or IRAs and you don't need it, then part of your estate plan for some of you may be to gift that to charity. You can now do that, and it's tax advantageous to you on your return. Next, are you going to leave money to your children? What kind of money are you going to leave them? If you plan in estate planning to leave them IRA, then they will be responsible for the tax bill at their level of income when you pass away. They will have to pay taxes and make distributions from those accounts. If you're going to leave money, if you're going to leave me money, leave me Roth. Pay the tax on it, give it to me tax-free. That would be a better deal. So I'll speak on behalf of your children. Go ahead and pay the tax now, Mama. Go ahead now, Daddy, and let me get it tax-free. I think that would be their word. Or you have life insurance policies that would be tax-free distributions. So there's ways in your estate planning to leave money to heirs and do it in such a way that you don't mess up your retirement distributions. Do be thinking about how to draw from those IRA, that TSP, so that it doesn't get so big over time that it creates a tax nightmare for you and for your heirs in the years to come. Okay, that's part of the estate planning concept. Next, assets at death. Are you giving them all to your spouse? If so, remember they go from the joint rate on taxes to a single rate, which is a much lower benchmark. They hit higher tax rates much quicker. So don't leave your single spouse alone with a bunch of IRA money, or don't be left with a bunch of IRA money with your federal pension and all that stuff. The tax bill will go up dramatically if you're not careful with that. So understand what's going to happen at the death of you or your spouse, what your long-term plans are for your money. Make sure that you're putting the money in the right buckets now and in those first years of retirement to accomplish not only your retirement income needs, but also your estate planning long-term. Okay, a couple more points and I'm done here. Your qualified assets being left to children have required minimum distributions. And do you plan on leaving assets to your heirs? Consider building a plan that allows you to gift to them while they are living. You can gift $14,000 a person to anyone you'd like, and there's no gift tax due on that. Now, if you pull it from your TSP, you have to pay tax on the TSP monies, and then you can gift that money to someone else. So sometimes we see this as a way to reduce the value of that required minimum distribution later, and to be able to provide better quality of life to your heirs if you see that in your plan you have more than you are going to need for your reasonable life expectancy. Spend time trying to answer those kind of questions. What will I need in retirement? What will I have in excess in retirement? What will my cash flow be? Look at those and find points in those details and make sure that you can come to a good answer of that question. Are you financially ready to retire? What we find is when people can answer that as a very affirmative, a strong yes, I'm financially ready, then the emotional piece will work itself out at the right time, again, typically in the middle of the night.